Now that we've looked at the simple circular flow between households and firms, and then we looked at the complications of leakages and injections, we can now label a more complicated diagram to see how it all fits together. So here on this diagram we have households, and on the left we have our businesses or our firms. Okay, we'll also label the rest of our simple circular flow. So here we have our product market, where we're buying and selling goods and services. And here we have our factor market, where we are buying and selling our land, our labor, our capital, and our enterprise. Okay, so let's start looking at the different pieces within this simple circular flow. So we know already that households are going to sell their factors of production in the factor market. So we have those factors of production going from the household to the firms. In exchange, firms will pay what we call factor payments. So that's the wages, interest, rent, and profits. Now, if we combine wages, interest, rent, and profits, we get what is called national income. So national income is the total value of what we earn. And it's different than gross national income, but gross national income, if you recall, was that total earnings, wages, interest, rent, and profits of Canadians, regardless of where they live. If we take the gross part out, national income is going to be the wages, interest, rent, and profits of people in Canada. So whether you are a citizen or not, as long as you are in Canada, you're going to be part of that national income. So there's a difference there. All right, so we have our national income, wages, interest, rent, and profits. And now the question is, what do we do with that? So we're going to label national income Y. And the question is, when you have your income, what do you do with it? Well, we buy things with it, right? Households buy goods and services. That was part of the simple circular flow. We call this consumption spending. Consumption spending is households buying goods and services. So what they get in exchange, of course, is the goods and services. Now, we should specify then what's included in consumption spending. What do households buy? So when we talk about consumption spending, included in that are, included in that are durable goods. So durable goods are goods that are long-lasting. These are things that last a number of years, so your car, your furniture, even our electronics. We buy a television that lasts us multiple years. We also have semi-durable goods. And semi-durable goods last about a year, maybe a little bit longer. And that would include things like clothing and footwear. Whereas durable goods were automobiles, furniture, electronics. Then we have non-durable goods. And non-durable goods last less than a year. This would be food, gas, things we use up rather quickly. So as we look at our consumption spending, we can identify different types of goods: durable, semi-durable, and non-durable. Now, which of these do you think fluctuates the most when our economy is growing versus when it's shrinking? All right, does the amount of food you eat change if the economy is doing well or poor? Probably not. What happens when the economy is not doing well, when we're afraid we're going to lose our job, we cut back on the durable goods. the cars. We wait on the expensive purchases like furniture and things like that. So durable goods see the most variation throughout the business cycle. Now, when we talk about consumption spending, we have goods, we also have services. So, of course, taxi rides, haircuts, those fall under the category of services. If you check out on Blackboard, you can see a breakdown of Canadian spending on durable goods, semi-durable goods, and non-durable goods. All right, so we take our income and we buy goods and services, consumption spending. Is that the only thing we do with our money? Well, it's not. We have the financial market. The financial market is the banks. And so we as households, we do savings, which we'll label with an S. So our money goes into the savings account. Maybe you have stocks, mutual funds, bonds, investments. Those all go under savings. What you get in exchange is essentially an IOU. We call it a financial claim. Think of this as your bank statement telling you that your money is sitting in the bank. All right, so we take our income, we spend it, we save it. We also have to pay taxes. So our center box here is the government. So households give money to the government. We call that net taxes, and we'll label that with a T. Now we look at net taxes. Net taxes are taxes minus transfer payments. And that's because we only want to consider the money that goes to the government and stays with the government. Okay? Take out the times the government pays you. What we get in exchange is government services. So with our income, we spend it, we save it, we pay taxes. Okay. Now let's start to look at the rest of this diagram here. And so let's look at the relationship between banks and the government. Well, the government borrows money from the banks, right? Bank of Canada is the bank to the federal government. And so the government can borrow money. In exchange, there is a financial claim, an IOU, saying the government owes money to the banks. Well, what does the government do with this money? So the government borrows some money. They get money from you in terms of your net taxes. And combined, they do government spending, which we can label with a G. And this government spending is the government giving money to firms in the product market, and in exchange, getting goods and services. So the government is buying goods and services from businesses. This is an injection into the economy because it's money going to businesses that's not coming directly from households. Okay. All right, so we've looked at the government, and we really have two components left here. We have the rest of the world, and we have firms. So let's talk about the businesses here on the left. Well, businesses borrow money from financial institutions, right? If a business wants to expand, get a new location, buy more equipment, they often borrow money to finance that. So they borrow money, and then they have a financial claim, an IOU, in return. Well, what do businesses do with this money? Well, we call this, when businesses buy from other businesses, we call this investment spending. So the money is going from a business to the product market. So we look at the arrow going to the product market, and we'll label that investment spending. Capital I, since the lower I stands for interest. Now, when we look at investment spending, we need to consider what are the components of investment spending. What do businesses buy from each other in the product market? When we talk about investment spending, what we're talking about is non-residential structures. So business is going to expand to a new location. It needs to buy a new space or lease a new space. So non-residential structures. It also includes residential structures. So houses. Why are residential structures in investment spending and not in consumption spending? Well, if you think about when a new house is built, it is a building company paying trades companies to build it, right? They're hiring plumbers and carpenters. They're hiring someone to lay cement, someone to frame, and so it's businesses paying other businesses. So residential structures, new houses, are part of investment spending. When businesses buy inventory, it's part of investment spending. And if they buy capital goods, so machines, tools, that's all included in investment spending. When we look at investment spending, the investment spending that we're seeing here is actually gross investment. Now, gross investment is net investment spending plus depreciation. Well, why does this level of detail matter? Well, the thing is net investment, that's all the new stuff. That's a new McDonald's location, a new house. That's a new bottling machine for a Pepsi company. The depreciation is also adding to the economy, right? Because let's look at an example. Let's suppose that January 1st, we start the year, and in this neighborhood, we have 5 houses. Okay. Now, during the year, 3 houses are built. Okay. But one of those houses is actually a replacement for the fact that one of them burned down. Okay. So what are we looking at here? Well, how many houses do we end up with at the end of the year? At the end of the year, we have a total. So we have our 5 plus our 3, but one of them went away. So at the end, we only have 7 houses. Okay. So really the gross investment in this case is the 3. The net investment would be the fact that 2 of these houses were new. And then depreciation is the one that replaced the burnt down one. So our gross investment here is the 3 houses. So here what we're including the new builds as well as those that are replacing the old. And the reason we do that is because even if you're replacing the old, it has to be made. And when it's made, that means people working, that means money and goods flowing through our economy. All right, so businesses buy from other businesses, which means the money is going into the product market and goods and services are what we are getting in exchange. Okay. Now, we have to consider the rest of the world. So we talked before about exports and imports. Exports, the goods are going out. And the money is coming in. We call that money coming in export spending. So money is coming in because the rest of the world is buying from us in the product market. Import spending, remember that was a leakage, and that's because the money is going out. Import spending, or IM, the money is going out, and goods and services are coming in. So the arrows here are very important because they tell us where the money is flowing and where the goods are flowing. All right, we have almost everything labeled on this graph, so we need two more things here. Now, firms, we said, sell their goods and services in the product market. They sell it to other countries, they sell it to households, they sell it to government, they sell it to other businesses. So what happens is firms sell those goods and services in the product market, and they go out to households, to government, to the rest of the world, to businesses. And what do firms get in exchange? The money that businesses get from selling their goods and services is GDP, which we can also label with a Y. So gross domestic product. The total value of all final goods and services produced in an economy in a year. And we'll talk in a later video, why is it just final goods and services? But GDP is the total value of all final goods and services produced in an economy in a year. Now, because of these leakages and injections, we can measure the size of our economy here based on how much income we're making, or we can measure the size of our economy here based on the value of what we made and sold. But because the money that flows out flows back in, and because of that simple circular flow, we can measure the size of our economy in any of those two places. So you'll notice they've both been labeled with Y, and that's because at any particular time, those should be the same. The money we make gets spent, saved, or paid in taxes. Then households buy goods, businesses buy goods, the government buys goods, other countries buy goods, and we subtract away the money that's leaving to other countries for those imports. So we can take our income that we get, wages, interest, rent, and profits, spend it, save it, get it in taxes, and because that money then gets used by other parts of the economy, spent on goods by households, businesses, government, and the rest of the world, we can measure the size of the economy at either point. So all of these Y's should be equal. Well, we've introduced here two more markets that we haven't seen before. The financial market and then the rest of the world. So we saw previously the demand and supply for the product market and for the factor market. Well, we can create demand and supply curves in the financial market and the foreign exchange market as well. So the amount of money in circulation is set by the Bank of Canada. So it has a vertical supply curve. It's a fixed amount. Now the Bank of Canada can decide to produce more money, and we'll talk about how they do that later this semester, but that would shift the supply curve. Supply curve is still vertical because it's fixed. It does not depend on the interest rate. If we then incorporate demand for money, then that's what's going to determine the rate of return, the interest rate. So the more supply of money, the easier it is to get cash, then that's more people wanting to lend you money, so it makes sense that it would actually drive down the interest rate. So we can have demand and supply in the financial market just like we do in the other markets we've looked at. The difference here is supply is a vertical line. In the foreign exchange market, we're looking at the demand and supply for the Canadian dollar as it relates to other currency. So for example, we can have the demand for the Canadian dollar here. And who would demand the Canadian dollar? That would be foreigners who want to visit Canada. They need Canadian dollars. Or foreigners who want to buy our goods. They need Canadian dollars. So here's the demand. And then we have supply. How much Canadian dollars are we letting out into the rest of the world? And it's those two things that will determine the value of our currency. So if 1 Canadian dollar is equal to 80 cents US, and suddenly more people want to visit Canada, invest in Canada, want to buy Canadian goods, that increase in demand will actually make the Canadian dollar go up. Now, since we labeled that simple circular flow, we should be able to, from there, figure out how much money is happening at all the different parts along the graph. So let's look at a scenario where our national income is $1,000. And we know that national income comes from wages, interest, rent, and profits. Well, wages, interest, rent, and profits are paid for by firms, and that's this factor payments right here. Now, once we get paid $1,000, the question is, what do you do with that $1,000? We spend some of it, we save some of it, we pay taxes. So here we see that our net taxes are $100. Our savings is $200. So if savings and net taxes total $300, and we know that our income is $1,000, how much is our consumption spending? Well, we must be spending $700 because we're saving $200 and we're paying net taxes of $100. There's only 3 things you can do with your income: spend it, save it, pay net taxes. Okay. All right. So now let's look at other parts here. Let's look at savings. So households save their money. They save $200. Financial markets then have our $200, and they lend 50 of it to the government, which means how much do banks have left to lend to businesses? Well, 200 minus 50 gives us 150. So the business borrows 150. Now, what do businesses do with that $150 they borrowed? Well, why would a business borrow money? They borrow money so that they can grow their business, buy additional equipment. Well, if they're buying residential structures or they're buying inventory or capital goods, what's the name for this? It's investment spending. Okay. Now, the government, they got $100 in net taxes. They borrowed an extra 50. So now they have a total of 150. Well, why would they need this money? What do they do with it? They use it to buy goods and services. So government spending is $150. Now, we have the rest of the world, and then we have our firms to deal with here. Now, in this case, we have money going out and money coming in. And if $100 is going out into the rest of the world because we want to buy foreign goods, that means foreigners now have $100 of our money. Well, what do they do with it? They're not going to use it to buy goods and services in their own country. It really only has value if they use it to buy things from us or they invest in our businesses. So if import spending is $100, export spending has to be $100 as well in this simple economy. Now, if our economy is in a state of growth or shrinking, then we may not have that balance of trade. We may have one of them bigger than the other. But at any particular second in time in this economy, then what's going out is coming back in. All right, so we have households buying goods, businesses buying goods, the government buying goods, other countries buying goods, and then we subtract the amount of money that's leaving the country because the goods we're buying weren't made here. So we take $700 for consumption spending plus the $150 for investment spending plus $150 for government spending plus our exports of $100 minus our imports of $100, and we find that GDP is equal to 1,000. Notice here the size of our economy measured by the total value of our final goods and services is 1,000, and the size of our economy based on national income, so the money we make, is also 1,000. Okay, so if our economy is not growing or shrinking, then these two will be equal at any particular time.